Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residences so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Hey, we're talking about cash flow tonight.
Yes,
it made me think of not necessarily cash flow, but I just love talking to our kids about money.
Really?
Yeah, because it's just their concept of money is always growing and like morphing a little bit.
Yeah. I know where you're going with this. Yeah.
I don't know I don't know, but like we went to the vet today, and Eleanor's like asking questions about like, oh, you have to pay them, and how much is that? And
yeah.
She's kind of like trying to wrap her head around amounts, and so she has like known factors that she like bases things off of, but I there's nothing like novel or anything. It was just super interesting. I just remember
you were talking to me the other day about how you went shopping with her and she saw the grocery bill and she was like, how much is food? And you're like, right?
She did have that realization, and she was like, wait a second, so okay, like she had to like take a step back and like, so you spend that much like every time you go? And I was like, well, not necessarily. If I go do a smaller trip, it's not, this was a big trip. This was one of our like in-betweens. Well, I'm getting everything.
Yeah.
The toilet paper, I'm stocking up on stuff. But
you don't have to, for the record. You don't have to.
That's right. You don't have to.
Well, so there was a strike going on, and people were starting to stock up on toilet paper again.
Oh, I didn't
which everyone
realize
was like,
that.
It's all made domestically. You don't need to stock up on it. But anyways.
That's amazing. Anyways, that's beside the point. So yeah, she had this realization and was like trying to internalize like, okay, if you spend that much, you go shopping how many times, like how much is that a month?
Yeah.
She kind of totaled it up in her head, which I
do
was
the
like,
same thing.
Right?
Mine's at the gas pump, but yeah.
Okay, how much
am I spending on gas?
Right? And then I kind of logically asked that next question of like, if it costs that much, to get these things that you need, where do you get it from? And how much do you, make? And how much would you need to make, And so she was kind of like, yeah, okay, well, obviously you'd need to make more than what you pay on groceries. And I was like, yeah, because we pay for other stuff too, huh? And she was like, yeah. Like she was just like beside herself that you would have to make more than that in income. So
I know.
Like,
that's
cash
good.
flow is important.
Yes, it is important, but it's not the only
everything.
thing. And that's what I want to talk about tonight.
Yeah.
I think when we first got started, like that was all that we cared about. Right? Remember,
that was all I cared about.
We had all the big spreadsheet, had all the stuff, and you were like, what is that number after the mortgage is paid?
Money?
That's what I care about. And
I even had you make, I was like, I don't really care about the specifics. Like, just make me a color-coded spreadsheet. And once you crunch all these numbers, if this little box is green, I know it's a yes from me. Yeah. If it's red, no.
Which did work out pretty well for us, obviously. But I think the more I've learned about it, the more experience I've gotten, the more sophisticated I've become, the more I've realized that's not the only metric. And so that's what I want to talk about tonight. And we're trying this new format again, where you're going to ask questions that kind of lead the way. I'm going to attempt to answer them. And which by attempt, I mean use my notes that I've already made. Thinking this through. Just a way to try to guide the conversation.
Yeah, makes sense.
Yeah, so let's roll. I want to talk about cash flow and why it's not the bee's knees.
All right. I will probably learn something tonight.
I know.
I
you are still
love
all
cash
like
flow.
cash flow's the legit.
Yep. I'm like, oh, why would you wait if you could just get money now? But I understand. Like, okay, I'm willing to learn.
Okay.
So a lot of people think that high cash flow is the gold standards for real estate success. Why might this be misleading?
Yeah, because it's just one metric for the success of a property and the returns that you get from it. Yes, you do get cash flow, but you also get appreciation. You do get tax benefits. You get debt pay down. There's just a whole bunch of stuff. And some of the cool things about some like appreciation is that it can compound over time, right? A 2% growth every single year can really turn into something big over time. And so it's just...
Depending on what type of property you're buying, If it's a buy and hold, yes, that makes a lot of sense.
Having said
If
that,
it's a
like,
flip, not necessarily.
I would not intentionally walk into an investment that's losing money. That's not fun if you got to feed this thing every single month.
Sure.
But
Unless you had an exit plan.
sure. Yeah, I guess.
You know, it's like, well, imagine that you
Okay.
have this C class property
Okay.
and yeah, it is losing money right now,
Oh, okay.
but
Yeah.
you can do these repairs and you know that based on comps around the area, you can sell it for X amount of dollars.
Yeah,
You're going to
I
make it
guess-
all back.
Yeah, you're right. I guess I was thinking about people who I've talked to who they buy a place, they're losing money, and they go, "Yeah, but it's okay. It's for retirement.
Yeah, no, I wouldn't
Like
do that.
30 years from now, it'll be okay." Like, what? But yes, I agree. If you're like, yes, we
if you
bought a
have a
place
plan.
and we're going to fix it up and eventually get rents
Sure.
so that when it's stabilized, pre-stabilization, yeah, all bets are off. But post-stabilization, like, nah, you should be making money. It's not the only thing you care about, but you should be making money.
Yeah, it should be profitable.
Yeah.
Can you think about other factors that contribute to successful real estate investment beyond cash flow? You alluded to appreciation, tax benefits.
Yep.
Like dive into
Those
a
are the
couple of
answers.
those.
Yeah.
How did they work though?
So there's two primary types of way that you build wealth in real estate. Okay. First one is cash flow. It's money you take out from it.
Yeah.
And then you have the second one, which is the equity, the appreciation side of things. And it's the value of the asset going up, right? So it's the asset itself and then the cash coming off of the asset. And so those are like the two ways. And early on, we hyper focused just on the cash flow. We got some appreciation, and in some cases we got really we're like, oh, this is nice.
Yeah.
And then we rolled some of those into the warehouses. And I think that was at least my first peek at like, all right, this appreciation
This is a
thing is
thing.
like, this is cool. And so I just think that's like and I'm getting even more so now where it's like, I'll look at an investment and like, for example, we're flipping this house right now where we bought it. The debt on it's awesome. We're going to fix it up. In theory, we could refinance it and then rent it out. But I'm doing the math on it and I'm like, well, I mean, okay, I make like $100 a month. Cool. Or I could profit, I don't know, I'll pick a low number, $5,000. Right? Like, that's a lot of months.
Yeah.
That's a, what is it? Almost 5-year hold period, a little over 4 years.
Yeah.
Like, I might take the cash today.
Yeah.
And instead of the rental income, potentially, right? And so I just think that's the so that's the other thing, and it's good to have both, right? The problem with my flip is that once I do it and I sell it, the asset's gone, returns are over. Now I got to go do something.
Yeah.
The nice part about the cash flow is, in theory, like, yeah, you just manage it and it just kind of keeps going. And then every once in a while, you got to spin a plate and fix it up and make it a little bit better.
Yeah. So, I mean, that's kind of the next question was like, why would you focus on equity versus immediate cash flow? And what you're hitting on is like, there's different life scenarios where one might make more sense than the other. You know, like you were saying, if you sell, yeah, okay, you get this chunk of cash, but now you got to do something else with it.
Yeah.
Ideally. So that's not just sitting there.
Yeah.
But if you are ready to retire and you just want the cash or something like that, great. Or if you want to live off of that little bit each month, like it depends. It depends on what your needs are.
Yeah, I think about what we did, which was, again, we primarily a couple duplexes, that kind of stuff, and we were buying with the intention for long-term hold for cash flow. Again, I don't want to complain too loud because it worked pretty well for us. I was able to quit my job after 12 years.
Yeah.
I think in retrospect, I would have done it slightly differently. I think I would have, especially that first couple, I was like, we didn't need the cash flow. You and I both had good jobs.
Right.
And I think I would have rather have said, you know what, instead of getting the cash flow, let's find things that need work. Let's go through the stabilization process, and then let's roll those into bigger things and actually kind of, because that can compound quickly. And then at that 10 to 12 year mark, like, okay, I think we're at a point on this next one, once we stabilize it, we're just going to hold on to it and the cash flow would have been greater had that happened, because the value of the asset would have been so much bigger to begin with, because we were just sitting on buckets of equity instead of rolling it into new things. I think that was a mistake. It was not a mistake. It was an unoptimized pathway that we ended up taking.
Yeah.
And so I think that's something that I would do differently.
Yeah.
And now, after the fact, I'm finding places, and I joke, I'm like, I want the places the banks don't want.
Yeah.
And finding ones that are fixer-uppers, fixing them up, and then taking that equity and then rolling it into other deals and snowballing that. And eventually I'll get to a point where I go, all right, I'm going to take some of that equity off that roller coaster, off the compounding track.
Yeah.
And I'm going to park it into a long-term thing, get the cash flow, and go, cool. But I'm doing it a little backwards than what we probably should have, but
sure.
like, whatever.
But I mean, you have the opportunity also to educate people who are just starting out as well.
I would also make the argument, like, there were some times where interest rates were crazy low.
Yeah.
And it was kind of like, I shouldn't pass up on this opportunity.
Right.
It's never going to get any better.
Yeah.
But I don't know. It's hard. So anyways, that's my,
Okay, so let's talk a little bit about tax advantages. Like
tax advantages.
Depreciation, write-offs. How do those come into play when evaluating property's overall profitability?
Yeah. So you and I used to debate about this all the time. Right? Because depreciation is this phantom expense. It's not phantom, but it's this expense that you get to take that when you sell, you get to pay back. Yay. But essentially, whatever positive cash flow you might have on the property, whatever, you just have this big negative. And what you and I used to talk about all the time, I was like, well, you have this property here that the cash flows break even. We don't make anything. But because of depreciation, we get a whole lot back on our taxes. And so it was like, instead of us getting the cash flow every single month, we would just get a really big check one time a year. And you were just like adamantly, no, we're not doing that. And I was like, come on, it's be a good deal if we did that. And then ultimately we found deals that did cash flow, and we still got the depreciation. It was like, all right, cool. It's like a double win. But that's how that plays into it. It's just this expense and so it's another way of, it's technically not cash flow, but it presents itself like that when you're doing your taxes, which is nice.
Yeah. But
then
cash
if you sell the property,
back,
you got to pay all that back. So,
Yeah.
choose wisely. That's where the 1031 comes in, because you defer all of those gains, which is nice.
You don't have to pay it
Yeah.
right then. And how about write-offs?
Yeah, write-offs, those are the same things.
Oh, it's just expenses that you have. You can put that against
The
income that you make.
Like when we first got started, I guess technically still to this day, there's some percentage of our home that's part of the business. Part of our driving that we do for the business is all write-offs. My phone and my computer, because I use them all for my business. Those are all write-offs. And so those are things that, again, they don't, how about this one for a huge one? We technically, because of things like depreciation and all these write-offs, it lowers our taxable income. And so according to the old government, we don't make a lot of money. Interestingly, when I first quit, I wasn't working, you weren't working. We qualified for food stamps, and which just because on paper, that's what it looked like. And it was because of all these things. Now the write-offs, like, they're real, like those expenses actually happened, but it was like I didn't have a personal phone expense. I didn't have a personal car expense because it was all business stuff, and depreciation, and because of all that, like we technically was like, we decided not to because we don't need it. This is a paper thing, but we did qualify for the healthcare.gov insurance subsidy piece. And that's another weird, like, and it was a lot of money. And we were like, all right, this is a huge advantage of getting all these write-offs and the depreciation. We qualify for the cheaper insurance piece. And again, is that a cash flow thing? No, not really. But
it's still,
it is.
It still affects your bottom line and
yeah. So that's like, those are some of those weird, interesting things that played into it. I thought hard about like how awesome would it be to do food stamps.
Oh my word!
Oh dude!
No, I stuff like that. I'm just like, no, like it feels like
somebody who needs
you're
it.
taking advantage of of the system at that
Dude,
point.
I'm playing the
which is
game.
like,
That's all.
yeah, which I'm like, I think that's what I don't like about it.
No,
Like, you're playing this game.
I would argue you're just against it because there's a social stigma against it and it implies something else. And that's not our situation. But
I
I'm
wouldn't
like,
feel bad about it. Like, if we qualified for it, I'd use it.
well, what's the difference between using, this is fun to debate this. What's the difference between using like food stamps and taking a healthcare subsidy? Aren't those one and the same? In both situations, they're based on having a low income.
Well, I guess you're right. With the food stamps, it felt more like we were taking someone's spot, whereas with insurance, it didn't. But maybe we were.
Yeah, I don't know how that
I
works.
don't know how that works.
If there's a,
I don't think there's a limit.
Is there a bucket of funds, and then once it's up, you're done, or is it if you qualify, you
See,
qualify?
That's what I felt like for food stamps. I thought it was like there's an amount
That's a good
that they
question.
put towards it, and like they have to say no to some people.
Or they divide it by everybody and
Right. And
call
it
it good.
changed. I
That's a
don't
good
know.
question.
It is an interesting question. And I don't know. I was just making
I don't know.
assumptions though.
oh man,
Because like for the insurance, I was like,
Dang.
they just pay it all
We've
out.
been getting free food and we just made assumptions.
What?
Ah,
Come on. That's all right.
that's right. It's okay. We didn't need it.
Ugh.
But those are some of the benefits, right? Of those are different parts of the deal that are worth paying attention to beyond just the cash flow, because they are real benefits. And the ones that we just talked about don't show up on a regular P&L because they happen all after taxes, all after the fact. And so that's where again, in a perfect world, like, yeah, you want it all. Like, find a deal that has really good cash flow that's after it's stabilized, right? And yeah, it's good. And ideally one that you don't get there by, you can force cash flow by just doing a bigger down payment as well. Ideally you don't have to do that, but yeah.
So
all these other ones show up after the
this
fact.
is kind of like a tangent a little bit, but I think one of the reasons why I also push back is because it gets complicated. And
Okay.
I'm like, I don't fully understand all the ins and outs of what I'm counting for write-offs or how depreciation works exactly and when am I going to have to pay that back and how do I calculate amounts? And so there's this level of complication that I'm just like, I don't want to make a mistake.
Yeah.
Like what would you say to someone who's like, who's trying to process that and is like, I just don't want to deal with that. I'd rather just look at the easy numbers.
Well, there is the option of just passively invest in something else and let the sponsor worry about all those things. There's that. I think there generally is, if you're going to go actively, like, yeah, you got to take the time to learn it all. Like that's part of it. You know, that's part of the education piece. Yeah. Understanding how it all works, not just waving your hands in the air and saying whatever.
Were you just marry an analyst?
Yeah, that is also who is looking at the entire spreadsheet, not just the green,
not just the green box.
The green box, but recogning the green box has to be there.
I feel like I won big on this.
Yeah,
this union.
But yeah, and I mean, I get it. If something's got good cash flow, chances are all the other stuff falls into place as well.
Yeah.
Outside of the appreciation piece, like that part is big. Because again, like you were just talking about, right? When we bought places, your requirement was it has to be cash flow positive day one. Yeah. Right, which made it hard. Whereas now I'm more like, how about just within that first year? And because now I can buy a place that doesn't make sense, but after I stabilize it and put in some time and effort, it will cash flow, and then I could either refinance it or sell it and get the funds out that I put into it, or not, whatever, depending on how it was financed. Yeah. And yeah, so that's the kind of where I'm like, nah, I'm going to push back a little bit more. Now, I also have a track record, and oh, if James says he's going to do this, it's going to happen. Yeah. And that, I think, is a change from when we first got started. Yeah. You didn't have that level of belief yet. Yeah, which I feel like that, what I was going to say earlier is if you're working with a sponsor and you want to passively invest, there is a level of trust there. And it's like, yeah, totally. We've built that trust over time. And now I'm like, oh, absolutely. I get that. Yeah, it maybe is not going to cash flow day one, but you have this plan for how to get it to a spot where it makes sense. Yeah. And it is a good deal. Right. When I say we're going to fix it up and we're going to rent it for this much, you go, oh, I know he's going to because I have experience. Yep. Finding tenants and screening them and knowing what the market is. Yep. And like, yeah, you can trust all that.
Yeah.
Whereas when we first got started, I
It
was,
was like,
I was not good at it. But now I am.
There was a big difference too of when we were going to live in the properties we were fixing up,
Yeah.
which we're
there was
not
that.
doing anymore.
There was
I
that.
feel like,
I think it was
a couple other factors.
Yeah. It was after the second one. You were like, never again. And I went, well, and I got half of one with this house.
Living in a construction zone.
Yeah.
This house was good. Okay, so let's talk about market cycles. Did you already talk about that?
I don't remember.
Explain the importance of market cycles and appreciation when considering a long-term real estate investment.
Yeah, so this comes back to just like understanding appreciation piece of it. And not only, understanding appreciation and just how market cycles can affect rents and rent growth in particular.
And by market cycle, what do you mean?
So sometimes, like, so we just finished a huge run in property prices, values going up. And now the question is like, okay, are they stabilized? Are they going to go down? Remember 2008, 9, 10, other direction. So you just want to understand where you are in these things, right? Like right now, again, we're top of the market. To buy a place and say, oh yeah, look at all this growth that happened in the last 3 years. I'm buying with that in mind. I don't know if I would make that assumption.
Yeah.
Or rents, they grew huge. Like, I would not make that assumption either.
Yeah, because it's probably not going to continue.
But understanding that. And also, when you're on the low end, realizing like, oh man, values are just like stagnant, not doing well. But like, okay, maybe honestly now's the time to buy. Now our strategy is we find fixer-uppers, places that value add deals, and we negotiate well. And so we even get that at a discount. And so we build in a whole lot of contingencies so that I almost don't care about what the market, if the market cycle goes down or is flat, I still win.
Yeah.
If it ends up going up, I'm like, dude, home run.
Awesome. Yeah.
And so, so that's how I try to structure it. Those are harder to find, and not everyone can do them.
And they
Again,
take
I
a
like the
different
joke.
type of expertise.
I'm looking for the properties that the banks don't like. Yes, different type of expertise.
I do like when you do tours of different properties, you bring home a video that you're super excited about. And I'm just like, oh, what's going to be on this video?
I know. And I'm just starting to share those with others.
Yeah.
Because I'm like, people do love watching this. So I'm going to.
It's kind of fun.
I'll share them.
I mean, and you have the experience now to look at a property and you see the value in, I mean, I look at the property and I go, that is a dump. And you're like, yeah, I know.
Both are true.
It's great. But
yeah,
you can see that potential.
Yeah.
Okay, so debt pay down. How does debt pay down factor into the success of real estate investment?
Yeah, debt pay down is kind of an interesting one. So in general, you're probably going to have debt on it and you're going to make payments, and some of it goes to principal, some of it goes to interest. What's cool about paying off debt is it's guaranteed building wealth. Now, depending on your interest rate, the percent return may not be great, but it's there. And there are a lot of people where, like, I think about our situation, right? We've got a good sized portfolio. If we did nothing else, and we're like, let's just focus on paying off the debts and get rid of the mortgage, dude, our cash flow would be unreal.
Yeah.
We're paying a little north of $15,000 right now a month towards mortgages. Dude, could you imagine?
That's crazy.
Which, that's almost all of them. That's separate from insurance and taxes. I pay them. No, all of them are separate. So like, that's just a big deal.
Yeah.
And
that's a huge number. Yeah.
Yeah. That's excluding our primary as well. So all that to say, like, I think there are a lot of millionaires, a lot of people who just by saying, I'm not going to worry about the cash flow, whatever extra cash flow I get, I'm going to pay off my debt, because they're looking for that longer term. All of a sudden, when that's paid off, boom, it's going to jump huge. And it's guaranteed. That's what's cool about it. Now, should you be doing that? I don't know, but kind of depends on what your rate is.
That's what I was going to say. It depends on your interest rate.
Where you are in life and the rest of your portfolio. I don't, but you could. And again, it's a guaranteed return, which is kind of nice.
It seems like to me that is a good end game strategy. Does that sound weird?
Yeah, I hear what you're saying.
I mean, it's like if you've accumulated some properties, you're managing them, and it's like, okay, I want to slow things down. I'm not going to buy new things.
Yeah.
But I'm going to put any profits towards my mortgages so that my cash flow goes up. And then over time, you're living off that cash flow. And
Yeah, one of the big strategies that I've heard was, say, all presumes you got a good job and you can afford to buy. But like if you buy a place either every year or every other year, like and just single family homes, right? And every other year seems plausible if you got a good job and you're living below your means.
Yeah.
Like, okay, in 20 years, again, normal life working time, you'll have 10 of these things. What you then do is you find your lowest 5 performing, sell them, and then take the proceeds from those sales and pay off as much of the mortgages of the other ones as you can. And maybe it's like you focus on one and then whatever's left over, you keep kind of rolling through different buckets. And what's cool about that is managing 10 properties is kind of a lot.
Yeah.
Managing 5 is very doable.
Yeah.
And that's where like, and you could just self-manage them if you wanted to, or heck, you could even have a property manager or whatever, but your cash flow goes up dramatically.
Right.
And for less work. Like that's kind of a win. That's the cool part about paying off debt.
It kind of reminds me of the like consumer debt snowball
Yeah,
type of
it's very
thing.
similar to
Where
that.
you're just like, okay, I'm gonna just like any profit that I get, I'm gonna pay that off, and then the payment I was making to that, I'm just gonna pay that off.
Yeah.
And you
Yeah,
make more money over time.
because there's different strategies, right? Let's say again, you got a job, you got some money, or let's just say your investments are throwing off cash. You kind of there's probably more, but there's like 3 choices. One, you can use it to go do fun stuff, live life, right? Just put it towards your daily expenses, just whatever,
or live
whatever.
life, sure.
Yeah, you could do that. You could save it and then go and invest in something else eventually. Or you could say, nope, I'm going to use that to pay down my debt. Now, what's interesting about that is the one where you just spend on your life, your future return on that money is now 0. It's gone. If you pay off the debt, that's that like guaranteed whatever interest rate it was, you just got that return, which is cool. Or, and this is where a lot of people tend to fall, they go, if I save it, maybe put it into an index fund in the time being, and then invest it in something else, I can earn above and beyond that 6%. I can earn 10, 12, 15% on my money, and that will actually like be more. Now there's a timing piece, right? Like if it takes you 5 years to buy your next place, you're probably better off to pay off the debt. But if you are generally able to do something every year, every other year, like, nah, you should keep rolling. Like that's what you should do. Yeah.
What are some examples of deals where low cash flow didn't necessarily mean the investment was unsuccessful? I feel like you've hinted at a couple of these already.
Well, I think there's anytime you can do like okay. I was going to say like anytime you do like a low down payment, that could be one where your cash flow is low, but it's still a successful investment. Because when you're calculating your return on investment, it's money out or money you get from it divided by money you put into it.
Right.
And so if you can lower that denominator, all of a sudden, even if the cash flow is not great, the number looks huge. So I think about like our very first duplex was one where there was a program going on where we got like $9,000 cash back for buying it. And so it dramatically lowered how much money we put into it, which is very cool. And we had pretty good cash flow. But as a result, our return on investment was like 52%. It was unreal. And we were just like, oh, cool.
Whoa.
But it was less of a factor of us making bank and more of a factor of, we just didn't put a lot into it. And so I think that's one where technically, cash flow is low, but like you could do that over and over and over and over and over again. And I have been more pursuing those types of creative types of deals so I can put less money into it because it lets it the returns get astronomical really quick, which is cool.
Yeah.
So I think that's a pretty like, that's a situation where cash flow doesn't look great, but who cares? No, from an absolute standpoint.
Yeah. Probably another example of that is what you were talking about, finding like a garbage property that's not going to cash flow day one, but you're going to flip it and it will.
Yeah. Or it never does, right? In that particular case, like.
Right. It never does because you're not holding it and renting it.
Yeah.
You're selling it
Yep.
and making your profit there.
Yep.
Why is it risky to only focus on cash flow when building a real estate portfolio?
Yeah, I think the big thing is like what happened to us. It just blinds you to other opportunities. There probably were deals early on that we should have bought, but
Interesting.
because there was opportunity to improve it and make the asset worth more.
Yeah.
And we just didn't. We didn't even consider it. And so I think that's probably the biggest risk of all. Again, worked out okay, but I think we grew slower as a result of it.
Yeah.
Yeah.
Missing out.
That's probably the biggest
What's
risk.
the quote? Like, vision is 20/20 in hindsight.
What?
Isn't that a quote? Isn't that a thing? It's like a saying.
Hindsight is 20/20. I know that.
Is that it? I think that's it.
Yeah.
Hindsight is 20/20.
Wow.
Well, you see things clearly when you look back at them.
That's hindsight is 20/20.
Got it.
Yeah.
There you go. I got it. I
Vision is 20/20 in hindsight.
I mean, whatever.
Guess that technically works.
We're recording late, okay?
Okay, fair enough. Fair enough.
No, yeah, it's, had we known, we would have done it differently, but
Yeah, we're learning.
it's all right. Can creative financing or other strategies sometimes lead to more successful investments, even if cash flow isn't high?
Yes.
That is a yes or no question. Give me an example of creative cash flow or creative financing or using other strategies to make a deal good or valuable.
Yeah, I think it comes back to all those same examples, right? If you are going to go down a creative or low down payment pathway, there has to be some sort of value add component to it for the deal to make sense. And that usually means up front, there's going to be really low cash flow. And you got to be okay with that.
I don't know what there's probably some economic relationship thing of how they all work together. Like if one is low, then the other is high. And here's how they adjust when you move them around. And
well, it's just the chances of someone just giving away a property are super low.
Right.
I mean, it happens, but they're super low. And so if you're going to do some sort of creative thing, it just usually means you're going to pay a little bit more as well. Yeah. Like that's the other nice. If you can walk in with cash, you often get a discount, but it's cash.
Yeah.
And so, so I just think that's just something to keep in mind if you're ever going down the creative route. You can do it, but it's probably not going to make sense as a buy and hold because your cash flow is going to be super low.
What is the most creative deal you have put together? It's not on the list. As far as like creative financing.
I mean, our apartment building was pretty high up there. That one was pretty sweet. It was a 11-unit place. We ended up getting 3/4 of it funded by a bank, the other quarter of it funded by the seller, and then I paid the $3,000 closing costs, and then I ended up taking out a personal line of credit to do all the repairs. And then once all that was done and it was stabilized, we refinanced, pulled out enough cash to go buy another 5-unit place. That was like a home run out of the park deal.
Yeah.
More recently, bought a single family home. Guy was in foreclosure. And what we ended up doing with that one was there were 2 loans. Both loans were being called due. So we raised the funds from other investors to pay off the arrears on the first mortgage and then fully pay off the second mortgage. And then we took the first mortgage subject to him still holding it. So we bought it with that mortgage in place, plus we had our other investors on top of it. And one of our investors was the ultimate buyer as well. So all incentives were aligned. That was pretty creative. And then our most recent one, we bought it from a seller. They owned it free and clear. And we gave them a couple options. We're like, hey, we'll buy it for cash for this. But if you want to be creative, we'll do this other one. And they chose the creative option. And so we bought it for $25,000 down, $160,000 total. And then they took a note for the rest.
Whoa.
No payments or anything until we're done fixing it up. And then, and so we raised the $25,000 from people. And then we budgeted $95,000 to do all the repairs. So we raised $120,000 for it. again, and we just got notes from people. And so that's another one where we actually have 3 mortgages on that property. And
but you're going to sell it and then pay it all off.
pay it back. That's the idea.
Huh.
Yeah.
All right. That's creative.
Yeah.
Last question. What advice would you give to my 20-something-year-old self who was only obsessed with finding high cash flow properties, but missing out on other aspects?
How would I have got you? I think, it's funny. We see this in the game Cash Flow, where it's this game by Robert Kiyosaki where you're going around a board and you fill out financial statements, which I think is awesome, but you're like, that's a game. And in this game, you can buy rentals and you can buy them for cash and you get cash flow. And then every once in a while, someone comes along and will buy that property from you. And from the game, right? Like what gets you out, right? It's not that, I bought a place and I just kept buying and kept buying and kept buying. It's eventually some buyer comes along, offers you a lot more money for it, and all of a sudden you have this stack of cash, and then you play the Monopoly game. You go from the couple greenhouses to the Red Hotel, and you then go do a big deal.
Get a bigger property.
And then it's at that big deal where the cash flow starts to matter.
Yeah.
And you're collecting cash flow all along the way, but ultimately to, quote, win the game, it's all about trading up to something bigger. And so I think talking to you and yourself, I'd be like, cash flow is important. Ideally, you're not feeding this thing every single month, but break even might be okay. If you have line of sight to increasing the value of this thing and then selling it. And I think I would have talked a lot more about that.
Yeah, I think had you given me like you were saying, a concrete line of sight with like clear examples of like, okay, here I'm gonna like lay out on the whiteboard, which we had like a full
we had a
wall
massive
whiteboard.
Which I wanted that for my birthday, and you're like, "That's the dumbest thing ever." And I was like, "I don't care, trust me."
I'm like,
and now you're like,
"This thing." We still have it. I use it all the time.
I know.
I think I use the inside one way more than you.
I know. I ended up buying a second one.
You have your own
because you guys stole that one.
Okay, that's like a tangent. I think had you whiteboarded out both of the scenarios for me and been like, "Okay, here's what it looks like if you get high cash flow properties. Let's zoom out." 10 years from now, 20 years from now, here's what this is going to look like. And like, bear with me. Let me like script out what the other thing looks like. It's like, this is the trade-off. Like, okay, we're not going to have cash flow, but like we have income from our other jobs. Like you were saying, here's our cash flow statement. It's like, we're going to be fine, even if it doesn't cash flow. And then over time, like here's the exponential growth.
And I think it's that recognition that it takes time. Like this is a 10 to 15 year process. So it's okay if you're not collecting cash flow day one.
Right.
If you're not maximizing that day one, because it doesn't matter until 15 years from now.
Right. And I just don't think I had that.
Me neither.
Longevity viewpoint.
Yeah, I agree.
It was like, but this month, like, what is that going to look like?
Yeah.
And
I think for us, it was like, because we both were working, we both had good paying jobs. We were like, I don't have time to do flips, which in retrospect, I'm like, I could have hired someone, but I didn't know that because I was still just getting started.
Yeah.
And so we were like, no, we want to do the cash flow because that's the thing that gets you out of the rat race. And it was like, it's totally true. You just don't need to do it day one. Right. That's probably be my big advice is you don't need to optimize you don't need to try to maximize the cash flow day one. Instead, I would maximize asset growth and really focus on value add, fixer upper type of stuff. And if you don't have the time, energy, expertise on how to do that, partner with someone else who is doing it and go along for the ride with them. Yeah. And that's kind of a best of both worlds. And I would have considered something like that when I was working and didn't have time to do it all. Yeah. Yeah. Interesting. There you go. So that's cash flow. That's why it's good, but it's not everything. And I think it's important to think of the other stuff as well. So hopefully that was informative and you learned something. Yeah. And if you did, I would love it if you left a comment or even just a rating wherever it is that you listen to podcasts. And if you are interested in tagging along with what it is that we are doing and investing in some of those more let's grow deals and or cash flow deals, you can check us out at furlo.com. Again, thanks for listening. Have a great day.